Hello and welcome to Sense Business YouTube channel. Today we will be covering cash and cash flow. In this lesson we will learn the importance of cash to a business. So why is cash important to a business? It might be to pay suppliers, to prevent business failures, and we'll understand the difference between cash and profit. And then we'll understand and move on to get to know cash flow forecast. So what might be inside a cash flow forecast? So cash inflows, outflows, net the cash flows, opening and closing balances. I'll explain each and every one so that you're ready for your exam. Okay, so first of all, let's understand the importance of cash. Cash is important because we can make payments for things that make your business run. So cash is used to pay for expenses like stock or raw materials, employees, rent, and other operating costs. Imagine if you didn't have cash, how would you be able to pay people? So cash is very important for businesses. In fact, cash is king. It is an old saying, but it is very true, because when you have cash, you can invest, you can expand, and you can deal with unexpected breakdown. So imagine you have a big machine that's broken down and you don't have cash. What will happen? You will not be able to fix the problem and your business might not make any money at all. But if we did have cash, we could quickly fix the breakdown and our machine would be up and running in no time and our business can make money. So that is why cash is important and cash is the king. So like I said earlier, cash could help us prevent business failure. It is also known as insolvency. So a company is insolvent, meaning unable to pay its debt if it either does not have enough assets to cover its debt. For example, value of assets is less than the amount of liabilities, or if it's unable to pay its debt as they fall due. However, if you have cash, you will not need to worry about this, as you will be able to pay off your debts when they are due. So do you see how important role cash has for a business? Cash can prevent business failures. If a business runs out of cash and cannot pay its suppliers or workers, it is insolvent. The owners must raise extra finance or cease trading. This is why planning ahead and drawing up a cash flow forecast is important. In about 2-3 minutes, I'll explain to you what we'll go through cash flow forecast, as it identifies when the firm might need an overdraft. You might get a couple of adverts in these videos that I upload, but don't get annoyed by them. That's how I can afford to upload more and more videos for you. Difference between cash and profit. I've noticed that a couple of people don't know the difference. They're like, oh, money is cash, cash is money. Profit, no, it's not. Cash is like air, profit is like food. You need cash all the time, but you can survive for a while without a profit. So cash refers to the amount of money currently or soon to be available. It is the money coming into the organization either from investors or direct business activity, and serves as the resources to pay expenses. Profit, on the other hand, is the amount of money left over after all expenses are paid. Mathematically, profit is simply revenue minus expenses, whereas cash is all the money that a business receives. Okay, what is cash inflows? What is cash flow? The short answer is the amount of money coming into a business and the amount of money going out of the business. That is all you need to know for cash flow. And that's what basically it means. Money coming into the business and going out of the business is cash flow. Think of it as a water tank. Water comes in at the top and drains out the bottom. So to keep your tank nice and full, you want more money coming in than going out. So we can use that example for our business. If we have a business, we want more money coming in than money going out, because if we are giving out too much money, then we are clearly not making any profit. So cash flow can be positive or negative. Naturally, a positive cash flow is preferred. Positive cash flow means your business is running smoothly and more money is coming into the business than going out of the business. A high positive cash flow is even better and will allow you to make new investments, hire employees, open another location, and further grow your business. We do need to keep in mind negative cash flow is when more money paying out, going out of the business than coming into the business. This is normally not a good sign when we have too much money going out of business but not enough money coming in to the business. What is cash inflow? Inflow is the amount of money coming into a business. Cash inflow is the lifeblood of your business and comes from sources like payments from customer, receipts of loan, monetary infusion from an investor, or interest on savings or investments. Here are some examples that I have bullet pointed for you because you do need to remember these as it might pop up on the exam. So examples of cash inflows might be customer payments, bank loans, bank interests. Bank interest is when if you have got some money in the bank and they pay interest to you, not when they are taking interest from you because they lend money to you. So this interest is when you have saved some money in the bank and bank pays interest to you. So that's an inflow. Bank interest, sales of fixed assets. So if you have some assets that you no longer need, you sell them. So that is an inflow because money comes into the business. Suppliers refund. If you're not happy with the product, so you send it back to the supplier and supplier pays you back. That is an inflow. Business owners, loans to the business, grants and funding proceeds. Okay, let's now find out what business outflows are. So cash outflows refer to all the cash that goes out of your business. As you can see, this guy handing out money to all its suppliers, banks, or what have you. So examples of cash outflows can be supplier payments, bank loan payments, bank charges and interests, purchase of fixed assets, dividends, salaries, wages, car lease payments, insurance, tax payments. So all these are your cash outflows. Anything that any money that goes out of your money is a cash outflow. So let's understand net cash flow. So net cash flow refers to the difference between a company's cash inflow and outflow in a given period. So the formula is cash receipts minus cash payments. You do need to remember this for exam because it might possibly pop up. So net cash flow is comprised of three forms of activities, which are operating activities, financing activities, investment activities. Operating activities This is cash both generated and used by the basic operations of a business, such as cash receipts from customer and expenditure for cost of goods sold and administrative expenses. Financing activity, this is cash received through a debt agreement or cash issued to pay off a debt, repurchase company shares, or pay out dividends. Investment activity, this can be cash received from a gain on an investment or cash issued to buy an investment instrument or purchase fixed assets. Opening and closing balances. The opening balance is the balance that is brought forward at the beginning of an accounting period from the end of previous accounting period, or when starting out a business. A closing balance is the amount remaining in an account within your chart of accounts, positive or negative at the end of an accounting period or year end. I'll show you this in a live example which will make a lot more clear, which will make a better sense, and you'll understand what I mean and what it means. So let's understand cash flow forecast. A cash flow forecast is a prediction of an amount of money expected to come in and go out of a business over a certain period of time. Generally, a cash flow forecast are prepared for a period of 12 months. However, if you run a small or a new business, predicting your cash flow for this length of time can be tricky, so it can help to focus on a shorter time period, such as 3 months, and use high level of figures for months 4 to 12. Then update your cash flow forecast on an ongoing basis as you will learn more about your business. There's no point of having a cash flow forecast if you're not going to update it. So what is the purpose of cash flow forecast? The primary purpose is it is a planning tool which draws out periods of time where a business has cash flow defects. It aids with planning for major business expenditures, for example, buying fixed assets, recruitment plans, and business reinvestment. It adds support to the sales planning process as well as a reality check when it comes to forecasting sales. Depending on the level of detail in the cash flow forecast, it can help identify areas of overspending and waste. So if we have detailed cash flow forecast, we can identify areas where we are overspending and try to minimize our overspending so we make more profit. Cash flow forecast helps business owners receive or achieve a deeper understanding of how their business functions, as well as its natural cash peaks and troughs. So cash flow forecast is good and good. Basically, it's a very good tool to be used in terms of a business because you can predict what's going to happen when. So here is an example of cash flow forecast, and this is how a small business or a regular business's cash flow forecast will look. By the looks of it, this business had no opening balance for April. So this cash flow forecast is for 6 months for your information. So on April, their opening balance was nothing. So we couldn't bring forward anything. However, their inflows were 25,000. Their outflows were 7,200. So their net cash flow would be this, take away this, which is this. So their closing balance for the month April is 17,800. So this 17,800 will be May's opening balance, because cash flow forecast is for opening balance is always closing balance is always carried over to the next month. So that means that our opening balance for the month May would be the closing balance of April, which is 17,800. And then in May we had 15,000 inflows, 12,000 outflows. So the difference between that and that is 2,800. So 2,800 plus our opening balance is 20,000. Sorry, altogether, yeah. So that plus that is 20,600, and then we carry on doing the same for 6 months, and we can predict what will happen, where we need money, where we might need an overdraft or loan to cover unexpected costs. So this is what a normal cash flow forecast will look like. Here is some questions that I have prepared for you. I would like you to comment in the sections below 3 cash inflows, 2 cash outflows. Is profit same as cash? Yes or no, and why? Name 3 things you will find in a cash flow forecast. Why is cash important for a business? Please make sure that you answer these 5 questions in the comment section below, because that's how I know you have learned the key points from this PowerPoint presentation. Also, don't forget to subscribe to my channel and share, like with your classmates. Thank you for watching, and I will see you on the next video.